Having so many options can be overwhelming. Come find out the 6 best high interest earning accounts for you. Also, we talk about a company that is boring but beautiful.
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. It is Friday, July 12th, 2024, and I want to offer again my congratulations for making it through another week. Now, it's been an interesting week. Certainly, we got some deflationary news. And remember, the difference between disinflation and deflation is that disinflation is the decreasing in an inflationary rate, but we actually got prices falling this month. We got a PPI number that certainly contradicted the number CPI told us. We got the start of Q2 earnings season, and certainly the path ahead has been forged with some of the things we learned this week. And here at InvestTalk, we like to talk about all of those things. But most importantly, we like to answer your finance and investment questions, be it voicemails, be it YouTube video comments, or hopefully over the next hour, live calls into our 24/7 voice line at 888-99-CHART. You certainly know that number. Now, with that being said, we got a lot of good things to talk about today that I'm going to bring to the table, and hopefully a lot of questions that you bring to the table. We'll also talk about the market performance as always, but first, let's tackle our first caller question now.
Hey, Justin and Luke. Love the show, as always. I started a position in BCH, which is a consumer bank in Chile, a little while ago, and it's up a little bit. But I was wondering if, in terms of making a play on nearshoring and onshoring, if BLX out of Panama might be a better option because it's more of a commercial bank. It's also got some really good fundamentals if the data I'm looking at is correct. And I guess more broadly, do you think that investing in financials in Central South America are a good way to play nearshoring and not shoring? Thanks. I'll look forward to the answer.
So the question is about BLX, which I will butcher this pronunciation, but it's Banco Latinoamericano de Comercio Exterior, SA Class E. And it is a bank that is headquartered in Panama, I believe. And what it does is it has a commercial division and a treasury division that essentially helps fund growth within Latin American countries. Now, taking a look at a high level, you see geographically, most of the revenue comes from Mexico, then Colombia. Panama is up there at 2.5%. The rest of that 71% is primarily these Latin American and South American countries. And so that's an interesting way, and I kind of like the idea here of playing on nearshoring and friendshoring, which is rebuilding supply chains towards friendlier countries, closer countries, such that they're not as vulnerable to what happened during the global pandemic. And so investing not just in the stock indices, the stock markets, rather, of those countries, but also in the businesses that are helping to grow, helping to fund, helping to capitalize those investment opportunities is a great idea. Now, taking a look at this, I agree. Fundamentally, it looks solid. Its interest income is on a great growth trend right there, slightly underperforming its growth and interest expenses, but the margins are still fine. Its net income growing from 92 to 166 from last year to this year. It's a small bank. In terms of US dollars, it's 1.1 billion. So certainly a small bank, but it's funding less developed nations. It's got quite a bit of debt at 4.6 billion, but that's to be expected relative to how a lot of these banks capitalize. As far as cash flow goes, going back 2 years, it looks like it's on a steady trend upward. I like that. Its relative strength, certainly powerful, given that over the past year, it's up 39%. And it looks like it has beat its industry by almost 2% on an annualized basis year over year for the past 5 years. And so with this significant growth, I know that their fiscal year 2023 earnings were higher than they've ever been. They were record earnings. And so they've started to really expand their credit book in terms of developing these markets. So I like that. But you do have to keep in mind, some of the risks associated with this. Yes, friendshoring, reshoring, onshoring, certainly something that is a trend given what's happened in the past couple of years. But investing in banks that are primarily and really only providing credit to countries that are less developed than the United States, countries that are have different macroeconomic factors than the United States, gives you that diversity, yes, but there's also inherent risks to that. So rather than just investing in the broad-based market or investing in a bunch of stocks, you're really isolating onto how well one bank does. And it's certainly going to be susceptible to global and local macroeconomic headwinds. Regardless, I think this is a fine company. I think, like I said, fundamentally, like you said as well, fundamentally it looks strong. And on a relative valuation basis, it looks pretty cheap as well. So, given its run up, even with its run up, rather, I think it's still priced relatively well, but understand the risks associated with investing in this type of company that does business in these under or less developed, markets. Thanks for the call. Now, we got a lot of ground to cover in the next 45 minutes or so, and here's some of what I have planned for you, time permitting. Our main focus point today talks about how you can use high interest earning strategies this year, the 6 best high interest earning strategies for 2024, in fact. And so there's several effective high interest earning strategies, including high yield checking accounts, money market funds, CDs. We'll get into some of the other ones. And so understanding the benefits and the drawbacks of each option can help you make more informed decisions and optimize your returns and grow your wealth based on your financial needs. So we'll talk a little bit about those HYSAs, bonds, high interest earning strategies, and several other accounts that you may want to consider for your portfolios. We'll also touch on a story, a sad story of sorts, of a couple that won the lottery and then let's say they trusted the wrong person. And so what does that tell you about how you should go about putting your faith in people within the financial services industry, regardless of if you won the lottery or not? We'll also touch on bank earnings that started this week, really the harbinger for how the economy is going to do moving forward. The first in the cycle of Q2 earnings to come out. What did they say? What did the forward-looking guidance say about consumers? And how should that inform your investment decisions? And should we have some time at the end of the show, we'll look at the trends of equity flows this week and what to expect moving forward. We also have some voice bank questions ready to play, including one on ETFs and another on APH, which is Amphenol Corp. I'm having trouble pronouncing words today. Well, we also have some questions that came into the comment section of the InvestTalk YouTube channel. And of course, we welcome your finance and investment questions now or anytime throughout the show at 888-99-CHART. That being said, we're going into a short break, and on the other side, we'll talk about today's market activity. Please remember, you can call right now, you can talk to me live, or you can call anytime of day, 3 a.m. if you want to. You know the number, 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Let's talk a little bit about the market today and this week. Dow finishing up 62 basis points, the S&P 500 up almost really over 0.5%. Small caps outperforming again, up 1%. And really, U.S. equities broadly finished higher, though off their best levels. The market paired gains coming into the close. The Dow, which I mentioned being up 62 basis points, narrowly missing an all-time high. And NASDAQ logging its 6th straight weekly gain, despite really was a notable sell-off on Thursday, that would be yesterday, and a divergence between small cap and large cap performance on the post-CPI rotation that you saw out of big tech. A lot of big tech actually recovering today, though somewhat mixed. Cyclicals among the best performers, again, including small caps, semis, home builders. Relative underperformers, large cap banks, a lot of which reported earnings, airlines, integrated energy companies. Gold finished pretty flat. Crude oil ending up down 50 basis points, reversing some of the gains we saw earlier in the day. I think overall the market largely shook off today's PPI report. Most of the focus was still on the post-CPI rotation dynamics from yesterday. So attention really is now shifting towards if the move that it made is sustainable, with the future rotation supported by what's been a performance gap and positioning narrative and broadening earnings growth profile. In fact, I think I mentioned this a couple times, there's some pretty high expectations for Q2 earnings. During Q2 earnings season, 8 of the 11 sectors are expected to report year-over-year growth. And so the PPI report I mentioned earlier came in hotter on headline and core may revise upward on both measures as well. And that's following a day where we saw deflation from CPI. Lower gasoline, a big influence, but the release noted higher margins for trade services, really what was dragging that upward. Now for the week on the bullish side, as I mentioned, the disinflation traction with the cooler June core CPI print left the 3 months annualized rate just above the Fed's target at 2.1%. That's the lowest it's been since March of 2021. Dovish CPI left the market fully priced for a September rate cut, with now a 60 basis points of easing priced in for the rest of this year. There were also some positive takeaways from Powell's monetary policy testimony. Leaned a little bit dovish. Initial claims hit a 6-week low. And on a corporate side, Apple reportedly planning for a 10% increase in iPhone shipments on stronger demand for AI features. On the bearish side, there's a high bar, as I said, for Q2 earnings season. The bulk of the S&P 500 starts to report next week. More hints of some cracks in consumer resilience themes coming out of retail names and some travel names. Select restaurant stocks also showing cracks in those themes. And some AI scrutiny, which actually I will talk about in the newsletter to be released tomorrow. And that comes from a Goldman Sachs report really highlighting this underperformance of names that have leveraged AI monetization and productivity. Looking ahead to next week, Powell speaks on Monday, retail sales come out on Tuesday, and the leading indicators index will be updated on Thursday. And that's the market today. And before we move further, I want to briefly mention the KPP Premium newsletter, which will be distributed tomorrow. We distribute it every Saturday to subscribers. And this week, as I said, we mentioned in the KPP Insights section, artificial intelligence. There's been a lot of hype around artificial intelligence, but new reports are showing underperformance of names that performed well last year amidst this hype, and really a lack of realization of some of the benefits that people said would be realized in the top line and the bottom line of corporate earnings announcements. So what kind of money have the companies been spending and what return have they been getting? We talk about that in the KPP Insights section. In the stock ideas section, we mentioned an industrial company as well as a technology company. And in the portfolio management section, we touched on what makes a successful investor. So if you're interested in learning more, visit us at investtalk.com and subscribe. The newsletter will come to your inbox every Saturday morning. Now let's keep things moving and head back to the InvestTalk voice bank.
Hello, Justin or Luke. I had a question about, it mostly has to do with the inflation that has been happening, I think, maybe for the last 2 days. So my portfolio that I check on a daily basis went up dramatically within the last 2 days. It didn't appear to be any of my individual stocks. It appeared to be multiple ETFs. And I was just wondering, because I learned in a different show or podcast that this had to do with inflation. And I'm just wondering, is it that the impacts of inflation are happening now? Or did something happen more or less within the last 2 days that is causing this increase in multiple ETFs, even S&P 500? If you could just talk a little bit about that, I greatly appreciate it, just so that I have a better understanding. I know you always mention that the stocks are usually the best hedge against inflation, and I'm just wondering, is this a perfect example of that? Thank you. I love the show.
Great. So as we all know, ETFs are, at least equity ETFs, are funds that purchase stocks. Right. So in its basic form, you can have index tracking ETFs, active ETFs, but let's just think about them as these funds that are buying stocks. They're pooled funds. And so in the long run, a stock's value is its discounted future cash flows, right? The profitability it brings in, the revenue it brings in, the profits it brings in, it distributes back to investors and pays its debts. All of these things make up the spot price of a stock in the long run. In the short run, that can differ a little bit, and then you can find things that are overvalued, things that are undervalued. But in the long run, that's what a company's value is. And so when we say that inflation, the best hedge against it is stocks, that's because over longer term periods, right? Where is the increase in prices going? It's going to corporations, okay? And that's one of the things that drives equity prices higher in inflationary environments. Now, what you're talking about is something different, which is the ETFs you hold. I don't know what they were, but regardless of what they were probably appreciating in price because of the CPI print and what that said about the trend of inflation. And remember that we are in a era over the past 2 years where interest rates have been higher. The market's been waiting to be able to cut rates, and it will not cut rates. The Fed will not cut rates until inflation is brought under control. So with deflation for the first time, with inflation seemingly on the track to be cut under control, that's probably why your ETFs went up. Now we're headed into a short break. On the other side, we'll talk about whatever you want to talk about. Give me a call at 888-99-CHART.
Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success.
Now, my main focus point today concerns something that I think is of interest to pretty much everybody. So we're going to go over 6 of the best high interest earning strategies for this year. As I mentioned before, there's several effective high interest earning strategies, including high yield accounts, money market funds, CDs. But understanding the benefits and the drawbacks of each option can help you make really an informed decision of what is best for your financial situation and your financial goals. So earning interest on your savings is crucial to maximizing your financial growth, especially in a climate of fluctuating interest rates. Traditional savings accounts often offer lower returns, making it essential to explore alternative ways to grow your savings effectively. And so let's get into 6 of the best methods to consider. The first, which I'm sure you all are familiar with, is the HYSA, the high yield savings account. Now, unlike traditional savings accounts, HYSAs offer significantly higher interest rates, allowing your money to grow more quickly. Currently, some of the best are offering APYs between 4.5% and 5.5%, far surpassing the typical rates of, 20 basis points, 10 basis points that you find at traditional banks. Another option is a CD, or a certificate of deposit. Now, what CDs are is they're like loaning your money to a bank. They require you to lock your money for a specified term for a fixed rate, during which you cannot withdraw without penalties. They offer higher interest rates compared to traditional savings and fluctuate based on the yield curve at the time at which you are purchasing it. But when you do purchase it, generally, they're fixed. That's the benefit. Money market accounts, MMAs, combine the features of checking and savings accounts, offering the ability to write checks or use debit cards, along with a higher interest rate, typically around 4.5% to 5% right now. It's also important to note that these accounts often have variable interest rates, though, unlike CDs that can change with market conditions. Another one, reaching outside of the bank, are bonds. Bonds are generally safer than stocks, generally, and can offer good returns in excess of what you can get from some of these savings accounts. So what is a bond? Well, there's all types of bonds. There's government bonds, there's corporate bonds, but essentially the function of these things is all the same. You purchase these notes, you give a principal amount of money, and over a period of time, you may receive coupon payments, you may receive no coupon payments, but at the end of it, you're going to receive your principal back plus some level of interest that you agreed to within the bond's covenants. What are the benefits? Well, they offer incredibly predictable cash flows. Unless there's a default, certainly there's a risk there that if the company or the government that you're loaning your money to defaults, you're not going to be able to get your money back. So you have to keep that in mind as well. But the benefit to it is the predictability with the fixed rate. So certainly bonds are an important thing to think about when you're thinking about earning some money, even in the short term. Another option, rewards checking accounts. Often benefits such as cash bonuses or high interest rates on your balances, only if you meet certain conditions. And another strategy is through bank bonuses. Many banks offer promotional bonuses for opening a new account, which can provide an initial boost to your savings, but it's crucial to read terms and conditions to avoid fees that could offset these bonuses. Ultimately, the choice of where you put your savings should align with your financial goals. If you need accessibility, high interest checking or MMAs make sense. For long-term fixed rate growth, CDs or bonds may be preferable. As always, you should prioritize high interest debt repayment first, though maintaining an emergency fund is also crucial. Choosing the right place for your savings involves weighing the potential returns against accessibility and risk factors. And sometimes it makes sense for you to consult with a financial advisor because they can help tailor your saving strategy and your overall portfolio to your financial situation and to your goals. Why don't we answer another question? Let's head back to the InvestTalk voice bank.
Wanted to get your thoughts on Lemonade, ticker symbol LMND. It's been on quite the downturn for the past year or so. So I was looking to see if this is a buying opportunity and looking at their financials projections forward, just wondering if this thing can make a comeback. Thanks for all your help. Looking forward to the answer.
So Lemonade is not a beverage company. Lemonade is a insurance services company, ticker LMND. And to say that it has been on a downtrend is somewhat of an understatement, regardless, or rather, in spite of it being up 5% today, in spite of it being up 21% this year, since its high of about 183 over the past 4 years, it has fallen down to $19.59. And with that fall, its cash flow has been negative, turned negative years ago, and hasn't been able to get past that. Its profitability, also negative. Its earnings per share in 2022, negative $4.59, negative $3.40 in 2023, negative $3 in 2024, negative $2.47 is what it's projected to be in 2025, even with earnings upgrades. Now, in this time, they've also issued new shares. So when you see a company like this that has fallen off of a cliff, that doesn't make any money at all, where the short interest is 32%, not only is it not making money, but its cash flow is on a downtrend and it's not making any money. I don't see any reason to believe at this point in time, in spite of it being up 5% today, that this should be a long-term investment in your portfolio. Even where it is, it's a consensus underweight amongst analysts. So I'm going to have to give this one a thumbs down. Love the drink. Don't quite like the company. Now, in the next Invest Talk, we'll look into the story behind this headline. Fed rule change, big banks to save billions. That's on Monday, but for now, I'm Luke Guerrero, and I'm ready to answer your finance and investment questions. Call me at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation.
I'm calling today about ticker symbol APH, Amphenol. I've owned this company for about a year now. I'm up a good amount, almost 50%. I'm calling I need to do some consolidation in my portfolio. I was wondering if you could take a look and let me know if you think this company is worth holding, if I should just trim a little bit and, let it continue. I do like the future of the industry and the sector. It's only 5% of my overall portfolio, but it is one of my larger positions. So let me know your thoughts. So please take a look. Thank you. Bye.
So ticker APH, Amphenol Corporation. I'm not going to mince words. Great company. It manufactures a lot of things. It's a component manufacturer. It makes raw cables, coaxial cables, cable connectors, assemblies, sensors, antenna arrays, circuit boards. And it's a boring business that is run well, that consistently and continually does well. And so as we move more towards the proliferation of fiber optic networks in residential property, commercial property used by both corporations and by people, companies like this, and this company specifically, is going to be an integral part of that. Which is why this boring business has a consistent growth rate of nearly 10% over the past 5 years. Its net income has also been growing by about 9%. Its net margins sit around 14% on average, but they're increasing. 14.7 in 2018, projected to be 15.3 this year. Their cash flow straight up and to the right, just like their stock price. You see right here in about 2021, this thing started to take off like a rocket ship compared to the S&P 500. And so this is a great company. It's a very well-run company. And especially during the pandemic, when you had infrastructure shifting, work from home shifting, all these things shifting, fiber optic networks becoming more of a reality, it did really well. And I think it'll continue to do well. Now, that being said, its priced earnings right now about 37 times forward looking. Its price to book about almost 10 times forward looking. It's a little bit expensive. I wouldn't open a new position in it. I would certainly keep it on my watch list and never forget about it, because thinking about what happened over the past couple years, there could be the case, given slowing demand, that the industry has a little bit of a overcapacity issue in terms of its purchases. This could bring the stock price down. But to answer your question specifically, would I sell it? No. Would I trim it? Yeah, I'd trim it. 5% is not a crazy amount of your portfolio, but get it back within range. You're up a lot. It's certainly good to take profits. A lot of people don't ever take profits, and sometimes they let it slip away. But I would not sell this company. It's a very good company. It's a very well-run company. It's a great grower. It's boring, but it's beautiful. Thanks for the call. Now let's shift gears and talk about a happy story that turns sad and a lesson at the end. I think that perfectly summarizes it. Maybe it ends a little bit happy too. But in 2008, Paul Rosenau, a construction supervisor from Minnesota, won a Powerball jackpot of almost $60 million after taxes. Now, Paul and his wife, Sue, dedicated a substantial portion of their winnings, $26.4 million in fact, to establish a family research foundation to support research and families affected by Krebs disease. Why? Well, the disease took the life of their grandchild 2 years to the date before they won the lottery. Now, I wish I could say that the story ended perfectly happily, but if it did, we would not be talking about it today. And that's because the Rosenaus trusted their wealth to a financial advisor and insurance agent named John Priebe. Don't know if I'm pronouncing that correctly. Years later, John's management strategies would come under scrutiny for prioritizing high commission products over the foundation's financial health. Now, this is a story all too common, and not just for those who win the lottery. So what did he do? Well, he directed the foundation's funds into variable annuities, which are known for their high fees and high commissions, but limited tax benefits for non-taxable entities like this foundation. The financial products typically offer market risks of mutual funds, but cost a lot more. By the end of 2011, he'd allocated almost 93% of the foundation's assets into these products from various issuers. Despite the booming stock market at the time, the foundation's investments in these annuities did not see proportional growth, largely due to their excessive fees and the advisor's practice of frequently churning investments to earn more and more commissions, millions of dollars in commissions for himself, in fact. By 2017, the foundation's investment in variable annuities had not only underperformed, but it also decreased in value, despite favorable market conditions. The situation led to an arbitration with Principal Securities' company, where the company was ordered to pay $7.3 million in damages to the Rosenau Foundation for the mismanagement of their funds. So why am I mentioning this? Well, there are a few people who I despise more than those who take advantage of others within the financial services industry. Most people go to a financial advisor because they can't do it themselves. And unfortunately, there are people out there who prey upon those people. And although most, I'm sorry to break it to you, most, if not all of you, will not win the lottery. Again, I'm sorry. You still have to safeguard yourselves against these predatory people. So if you go to seek a financial advisor, which I still think is a good idea for a lot of people, it's important to seek one that has the correct incentives. One that is fee only, does not get commissions, which means they will not put your assets into investments because they get kickbacks. They are fee only. And ones that are fiduciaries, which means they have a legal responsibility to keep your best interests in mind. Now, on Fridays, we generally make time for a quick rundown of key benchmark numbers. So let me hit you with that list right now. The 2-year Treasury yield was at 4.451% today. For perspective, last week, that number is 4.616. 5 weeks back, it was 4.857. And 120 weeks ago, it was 1.961. The 10-year yield was at 4.177. Last week, it was 4.281. 5 weeks back, that was 4.416. And 130 weeks ago, that number was 1.762. Gold was priced at $2,413 per ounce today. Last week, that was $2,388. 24 weeks back, that was $2,018. And 124 weeks ago, that number was $1,806. Silver, the other metal, was priced at $30.82 per ounce today. Last week, that number was $31.38. 22 weeks back, that number was $22.80. And 117 weeks ago, it was $23.94. Oil was selling for $82.22 per barrel today. 2 weeks ago, the number was $81.51. 12 weeks back, it was $83.10. And 130 weeks ago, the number was $66.62. The national average for a gallon of regular gasoline is $3.53 per gallon, a 2-cent increase over the last week. 7 weeks back, it was $3.60. 58 weeks ago, it was $3.56. And 126 weeks ago, $3.57. California was averaging $4.76 per gallon, down 3 cents from last week. 6 weeks ago, that was $5.07. 37 weeks ago, it was $5.32. For comparison, in Oklahoma today, gas was averaging $3.16 per gallon. That is $1.60 less per gallon than gas in California. Why don't we grab another question?
What sectors would you say are best to be kind of deploying my cash into? I do a small amount of dollar cost averaging each month, and I have established stocks in the different sectors. I'm just curious of what your guys' opinions are on which sectors I should be trying to dedicate most of my cash to right now. Look forward to hearing it on the podcast.
Yeah, it's a great question. So, I think it's a great question, but a complicated question because you need to manage a portfolio in a holistic way. Meaning, if you have no money invested in sectors, certainly now it's a good time to get into industrials. It's a good time to get into energy. It's a good time to get into financials. Certainly it'll be a good time at some point to get into real estate because as interest rates start to turn, those are sectors that will do well. As demand picks up, those are sectors that will start to do well. But for you personally, the best way to answer that is to know what your current allocation is. Because you need to manage your portfolio, again, holistically. When you construct a portfolio, it's the whole thing. It's the whole picture. It's not what sectors are good for me to buy into right now. It's what changes should I make to my current portfolio to balance them in a way that they fit with my financial philosophy. And so maybe you're incredibly underweight tech, right? And even though we don't think now is the best time to get into tech, maybe you are drastically underweight them. Maybe there's no tech in your portfolio and you're completely missing out on tech. Then for you, tech is right. And so what I would do is look at the market as a whole, see what the market weights and sectors are, see how over or underweight you are relative to the market as a whole, and where you're most underweight within those sectors that tend to do well when you see this rotation we've seen over the past couple of days. That's where I would allocate. Looks like we got a little bit more time before the break, so why don't we play 2 in a row?
This is Rob from New York. Just calling about CVS. I bought it, a couple of years ago during kind of the low point of the market, and it's really had a run up. And now it's kind of stalled and sort of been coming down a bit. I want to see, do you think that this is a good time to take profits or potentially just hold out and hang on to it for the long term? I want to see what you think. Thanks for everything you do on the show. I've been listening for years. Thanks. Bye.
So I don't think I have to tell anybody what CVS does. I think we get a lot of questions about CVS, actually, now that I think about it. But I'll do it anyway. CVS is a health corporation, health solutions company. And they do insurance. They sell products at their local stores. And the company did really well during the pandemic. In no small part to the amount of money Americans were spending on not just healthcare, but products for everyday cleanliness, for everyday sanitization, for health. But recently, earlier in this year, it hit a little bit of a headwind, right? Closer to the end of April, I would say, when they released their most recent earnings. They're now set to release again in August. They saw increase in utilization, specifically within a particular age group that is going to be utilizing healthcare more. And so margins started to slip. And you saw the stock drop from, about 60, 68 down to 55. Now it's since recovered a little bit. Now going forward, I think that we're probably entering a choppy period, especially surrounding an election and uncertainty about the healthcare market and what it's going to look like next year in healthcare regulations. And so for me, as a risk mitigation perspective, and given that this looks like it's going to range in the 55 to 60 for quite some time, if you've been holding it for a while, I would start to take profit. I wouldn't sell off. I think it's still a company that has a lot of good prospects. It has a bit of debt, but a lot of that's pushed out long term. So even though it has $79 billion in debt, it's only levered about 5.9 times in terms of its interest coverage ratio. So it's got plenty of room to run. And cash flow, it's fallen from its pre-pandemic highs, but pretty much where it was, it's fallen from its pandemic highs, but pretty much where it was pre-pandemic. So certainly if you're up, I would take some profits, but I wouldn't be buying any more right now. I think there's a lot of uncertainty in regulation that's going to affect the healthcare market. And so the outcome of the election and what happens with the election is going to really tell us more about the healthcare sector more broadly. Thanks for the call. Now, I hope you've been telling your friends and family members about our InvestTalk audio podcast, but I also hope you've been telling them about our videos, which are available on our YouTube channel. Here's a question that came in yesterday. It says, Luke or Justin, I messaged you about an oil play I picked up a few months ago for 5 to 7 year holds, seeing if you see any revenue and earnings growth moving forward. The ticker is FANG, F-A-N-G. Also, when you're reading the estimates from your data, is the data you're reading from Morningstar paid subscription. So let me answer the second question first because it's the quicker one. We get our data through FactSet. We do use Morningstar, their paid subscription, but primarily we get our data through FactSet. It's very expensive. So for retail investors, for most of our listeners, or probably all of our listeners, it's not something that you would utilize, but Morningstar data is perfectly fine. Now, think about this company, Diamondback, FANG, full disclosure. We bought it for clients, I want to say back around 140-ish last year. And the reason why we liked it and the reason why we still like it is even with the recent price run up, it's still only trading at a forward-looking earnings of 10.4 times. And that's with sales growth that is fantastic over the past 5 years, up 31% on an annualized basis from 2018. But the other part of it is the structure of its payouts and that it commits a percentage of its profits to dividends every year. It's part of the bylaws. And so this company, which issued a bunch of shares back in 2020, but hasn't issued any shares since, really prioritizes returning capital to investors. That's something that we certainly like. On its balance sheet, it's got $6.8 billion in debt on a $36 billion market cap company. It's 13 times in terms of its interest coverage. Its earnings up and to the right. Its cash flow up and to the right. The cash flow growth, honestly, is pretty astronomical going from 2021, from $2 billion to $6 billion. So in 3 years, it's tripled. That's fantastic. And so the reason we hold it for clients, we like it. It's a well-run business. It's in a space that I think has a lot of potential to do well with shifting demand dynamics on a macro scale. It's an oil company. And so we bought it a while ago, even though we're up about over 40%, we're still holding on to it for our clients. So we approve. Thanks for the comment. See if we can squeeze in a quick question before we head to break.
Hello, would love to get your opinion on Thermo Fisher Scientific Incorporated. The ticker symbol is TMO. Thank you.
That was certainly a quick question if I have ever heard one. Let's take a look at Thermo, ticker TMO. And Thermo, it looks like, is a software research analytic diagnostic company. It is very small, about 208 billion in terms of its market cap. And it has a lot of debt. Is that number right? 36 billion in debt? Yeah, it's a lot of debt. Taking a look at what it does, it looks like maybe it even leverages its debt to... Oh, I'm sorry. I apologize. Let me take a step back. It's a $207 billion company, which makes the debt of $36 billion acceptable. I didn't think those numbers were working out correctly. But we're going to talk about Thermo when we get back from the break. This is InvestTalk. I'm Luke Guerrero, and we have one goal here, and that is to help you achieve your financial freedom. Our work continues after this break, where we will get to the rest of this question on Thermo Fisher Scientific, as well as maybe a live call. Get your questions in now before we head off for the weekend at 888-99-CHART.
We're here to answer your finance and investment questions. So make sure you give us a call at 888-99-CHART.
Do you want to be a part of the conversation? Don't forget to comment below so we can answer your questions on the next InvestTalk podcast.
So before we headed into the break, I think you all came to the realization that a lot of the time, this is the first time I'm seeing these questions or hearing these questions, and sometimes I can't properly read. So we got to the bottom of the case here. TMO, Thermo Fisher Scientific, is in fact a $207 billion market cap company, and its debt levels, therefore, pretty modest at $36 billion. Now, with that being said, this company did particularly well during the pandemic. Why? That's because it provided a lot of the lab testing resources for COVID tests. And so what you see here is that their net margins peaked out back in 2021, 2020, and 2021, that is, at around nearly 20%. So in 2020, it was 19, 2021, it was 19.7%. And it came back down to earth. The stock price fell off. It really bottomed down in November when the COVID testing business collapsed, but it's since been on an uptrend. Bottomed out back in November at $440. It's steadily climbed to near $600 per share. Now it's back down to $540 per share. Now, that being said, it's bought back shares consistently over the past 5 years. Its earnings have been recently upgraded as well. It's projected to make $21.68 next year, and its margins are projected to go back towards its pre-pandemic highs, or rather its pandemic highs. And so the question becomes, this business, which is one of the largest lab and scientific diagnostic provision corporations, is how do the growth prospects look? And so with consumers pinching their pocketbooks really towards the beginning of this year, I think as a willingness of consumers to spend starts to take shape going into next year, this company, who certainly probably won't reach the margins that it did consistently during the pandemic, just because that was a strange exogenous event, which will likely not happen again in our lifetimes, hopefully. I don't think it'll get back to those consistent levels of being in the 20% net margins, but that doesn't mean it's not a good business to own. Right now, it's trading slightly below its 5-year averages, though you have to keep in mind that is skewed by where it was trading during the pandemic. So I still think it's a little bit more too expensive, that is. It's trading at a price to book about 4.6. I'd probably wait for that multiple to come down closer to 4. I'd wait for a PE below 20, which is where it tended to be on average, excluding the pandemic. But either way, I think that the cash flow is in the right direction. I think profitability is in the right direction. And certainly it looks like the bottoming was in towards the beginning of this year. Now, before we head off for the weekend, I wanted to talk a little bit about major bank earnings. Major banks reported that lower income customers are facing financial challenges. During the second quarter earnings releases, executives from the country's largest banks, JP Morgan, Wells Fargo, Citigroup, highlighted issues such as depleted savings and the impact of inflation, particularly on consumers without significant investments in the stock market. Now, the end of the pandemic-related government stimulus has left many Americans vulnerable to price increases, and consumer sentiment is at an 8-month low. Citi has seen a significant drop in profits from its U.S. consumer-leading sector, while overall consumer spending is slowing. JP Morgan, the world's largest bank, noted some weaknesses among the less affluent customers who are shifting their spending from discretionary to non-discretionary items, often a sign that shows financial strain. The banking sector's earnings from lending have also plateaued despite prior gains from interest rate hikes, with banks now beginning to offer higher rates to depositors. Wells Fargo described lending demand as tepid, never a good word for people to use in forward-looking forecasts, and adjusted its profit outlook for loans downward. Now, it wasn't all negative. On a positive note, the investment banking segment showed incredibly robust growth, suggesting a potential rebound in deal-making activities. Certainly, as corporate activity moves upward, that is beneficial for the economy as a whole. So overall, this to me signals an economy that is healthier than a lot of people would have expected and on the right direction. From a corporate side, that's likely on the upswing. And with recent inflation figures showing deflation for the first time, potentially consumers see on the horizon some alleviated stress on their pocketbooks. Now, I'm Luke Guerrero. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Don't just tell them about the downloads. Tell them about our InvestTalk YouTube channel, because our podcast is available in video form on YouTube. Just search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.